Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in half an hour's time. Let's get to the stories we're following in the BNN Bloomberg newsroom. Shares of Tech Resources trading lower today. The industry minister, Melanie Joly, says she wants more from Anglo American in the deal to acquire Tech. The agreement is being scrutinized by Ottawa since it involves a company outside of Canada aiming to own a Canadian firm in a key industry. Joly says she aims to announce a decision on that deal next month. Shares of MTY Food Group are seeing some pressure today. The restaurant franchisor and operator has launched a strategic review process to explore a partial or entire sale of the company. The Montreal-based company says there's no assurance the transaction will occur. MTY owns restaurants like Mr. Sub, Baton Rouge, Extreme Pita, and Thai Express. We're also watching shares of Barrick Mining today. There are reports Elliott Management has built up a stake in the company, valued at least $700 million US. Elliott's an American hedge fund and activist investor that typically forces major changes at companies. Barrick, of course, has struggled to benefit from the gold rally, largely because of problems at some of its international assets. And according to Bloomberg, Microsoft and NVIDIA will invest up to $15 billion US in Anthropic. Anthropic will also purchase $30 billion of computing capacity from Microsoft Azure cloud service. The deal brings Anthropic closer to two of the biggest backers for its rival, OpenAI. Here's where we stand at the market. The TSX barely positive right now. It's at 30,078, up 2.16, 20% though over the last year. The U.S. market's in the red today. The S&P 500, the 34-point drop, 35 right now, so about 0.5%. The Dow Jones dropping another 415 points today, 0.9%, and the Nasdaq has a 186-point drop. North American stocks mostly in the red as investors ruminate over tech. Now, despite solid earnings, investors worry that companies are spending far too much on AI and won't see return on those investments. But let's see what else is troubling them. We welcome James Thorne, Chief Market Strategist at Wellington Altus Private Wealth. Thanks for coming in.
Thanks for having me.
What do you think is weighing on investors that we are seeing this longer streak of red?
The market needed a pullback. When you think about the valuations of AI, they are stretched. But, if this is a generational CapEx theme, and I compare it to the railroad, then we're still in the early phases. So we're going to go into these periods of euphoria and fear. I think we just need to get used to it. I don't think this is anything out of the ordinary. The holy grail is artificial general intelligence. We need to build it out. We need to build the infrastructure out. We need energy. We need materials. So, the market, in April, it was the end of the world. Mm-hmm. Then we rallied to 6,900 on the S&P. Now we just had a nice, normal, healthy pullback. And people that don't understand what they own, maybe they're too levered, are selling and providing a great opportunity for long-term investors to position their portfolios. Okay, so we knew about the valuations for some time. I'm just wondering, did you see a specific trigger to this fall off? No, being in the business as long as I have, you can get a 5 to 8% correction for any reason whatsoever. And, it was a hedge fund said it was, NVIDIA or Palantir were overvalued. Well, they have been. I mean, we could argue about NVIDIA with a peg of about 0.55 not being that expensive. But right now, with the market so overextended, we needed a pullback. And so the way I put it is it's for whatever reason, so we're having it. So this is normal, natural, and healthy. And what you have to ask yourself is, if we think about investing for 5 to 6 quarters in advance, what do you want your portfolio to look like? And I think there are some wonderful companies on sale right now that investors should start working their way into and start doing work on.
Meaning the companies that you're diversifying to, or some of the tech companies that you would pick up on now?
I think that the treasure hunt phase of this cycle is over and the winners have been identified. If you don't think NVIDIA is the leading edge company in the world in terms of AI, then you need to do research on it. Micron, we're having a super cycle in memory. I mean, Seagate. So the winners to me have been identified. I think the real question comes later on in the back half of next year when the Fed starts to cut rates, Trump's supply side policies kick in, and we start to see a reacceleration of the U.S. economy. Do we want to go and diversify into more interest rate sensitive areas at that point in time?
Let's talk about the weakness that has been seen here and there in pockets of North America. I'm wondering, since we don't have new data from the U.S. quite just yet, do you see that underlying weakness carrying on to the end of the year, starting off the new year that way as well?
No, because, this is an unfortunate comment that Chair Powell made about flying blind or in a fog. The case freight index, which covers freight in the United States, it's at lows. I mean, Home Depot, terrible numbers, ADP. So if you look at the private numbers, there is enough data to suggest that the Fed is too tight. So I do think they're going to cut 25 in December. And I think also what they've done is, you over here, you've got QT or quantitative tightening, which is, or the Fed's balance sheet, which is the amount of reserves that are in the banking system to keep things going. I think they've taken too much water out of the bathtub and they've got to start replenishing. And that's what the president of the New York Fed said this week, that, they might be purchasing 25 billion additional securities next year. Add on to that the reinvestment of about 60 to 70 billion. So you're going to get a liquidity flush. And to me, bull markets end with a lack of liquidity, not valuation. So I'm expecting liquidity to come back into the market, and that'll benefit risk assets.
Let me ask you about the Home Depot earnings. It was a miss on a number of metrics. Do you see that as a signal, as others are for retailers?
I think most of the other retailers are correcting. People call it this K-shaped recovery where the high end's doing great and the low end's doing bad. Look, Secretary Bessent said it the best. The Fed has caused a recession in the housing market. The interest rate sensitive area of the economy, which did not cause the inflationary pressures, have been attacked by the Bank of Canada up here and the Fed. And it's just not right. They didn't cause the inflation. So when you think about it, what the Fed and the Bank of Canada needs to do is get rates down to basically give some energy into the real estate market. So no, I'm not surprised at all by what's happening with Home Depot.
All right, James, I do have to leave it there. I'm out of time. Thank you for your time. Appreciate you coming in.
Thank you.
James Thorne, Chief Market Strategist, Wellington Altus Private Wealth. Coming up next, we'll talk a little bit more about Home Depot, down today after the company cut its full-year profit forecast. We're back in a moment. Shares of Home Depot down today after the home improvement retailer cut its full-year profit forecast after missing earnings expectations. Let's talk about it with Michael Baker from D.A. Davidson. Michael, thanks for joining us today.
Glad to be here. Thank you for having me.
So the company was banking on the lower interest rates to spur spending. It didn't. That didn't happen for them. Why do you think that is? Why do you think consumers in the U.S. particularly aren't spending?
Well, we're seeing a slowdown across retail, really. It happened to have been a very strong summer for retail sales through July and August. And starting in September and continuing into October and now November, retail sales have just weakened across the board. I think it's a function of a lot of different things: government shutdown, lower employment growth, just lack of confidence. But we're seeing the slowdown across the board. So, right, Home Depot did expect to see a little bit of a pickup in spending as rates have come down. We've seen higher refi numbers. We've seen higher HELOC numbers. but it didn't show up at Home Depot. And again, I just think that's a function of slowing consumer spending in general.
Okay, the lack of big weather events is something they also cite. That hurt them. Typically, is that a big driver for them?
That can be, particularly in the third quarter, and it was last year in particular. I think the market would forgive that more than the general slowdown that we just talked about. When it happens, sometimes it does, sometimes it doesn't. And if the miss were solely because of the weather, I think it would be a different story in terms of the stock reaction. But while it certainly was a big factor, we are also seeing this lack of improvement in underlying demand. Now, that's not to say it's gotten worse. The underlying demand, excluding the weather events, has been pretty stable, but it's not picking up. And we expect it to pick up by this point.
Okay, let's talk a little bit more about consumer weaknesses. I'm wondering if tariffs are part of that story, if prices are going up at places like Home Depot or the Walmarts or Dollaramas, and perhaps that's turning consumers away.
Well, sure. It's impacting in a couple of ways. First of all, we are seeing tariffs start to flow through on prices more now than we did earlier in the year, just a function of how those higher costs are captured in inventory and then flow through. So we are starting to see that, and that is leading to weaker unit demand. We're also seeing a little bit more food price inflation for various reasons, including tariffs, but also outside of tariffs. But we feel like that causes consumers to have to spend more on their needs, and therefore they have less to spend on their wants, and that hurts a retailer like Home Depot. A lot of Home Depot's business is repair and maintenance, so that's sort of a need. But there is a component of the business that's a want, to remodel, as an example. And when you're spending for groceries and those types of basic needs, you have less to spend on the discretionary part of Home Depot's mix.
Okay, we are having some trouble hearing you. I just want to let you know, in case I repeat sort of a question that you may have answered. The impact of the GMS acquisition, what did that do for the company?
Well,
okay, Michael, I'm sorry to interrupt you. We're really having a difficult time getting your audio, so we're going to leave that conversation there. We're going to take a quick break. We're back in a moment. Time now for Hot Picks. The market sell-off continues this week as investors worry about expenditure in AI infrastructure, that it may have been overzealous and that we could, in fact, be in an AI bubble. We are joined by Julian Klimochko, CEO and Chief Investment Officer at Accelerate Financial Technologies, who is recommending what he calls safe stock picks for a frothy market.
This market is quite frothy. If you look at valuations, they match or exceed that of the tech bubble more than 25 years ago. You're seeing various bubbles in the market, whether it's quantum, nuclear, AI, and whether you want to call it a financial bubble or industrial bubble. Some things appear unsustainable and should give investors and allocators pause. And with that, searching for defensive type positioning. So what I want to chat about today is two longs and a short idea, or an idea for investors to exit in what we view as a riskier than average market.
Loblaw is your first idea, obviously a classic defensive stock. We all need to eat.
Yeah, you nailed it there, Andrew. It is highly defensive, Canada's largest food retailer. So even in a choppy market or an economic environment fraught with risk, we all need to eat. So we believe that they'll provide that consistency and stable earnings growth that really provides a good floor for the stock. Loblaw is a leading market position, attractive both absolute and relative valuation, high return on capital, good shareholder yield, combining share repurchases and a dividend, And more importantly, in this market, as I indicated, defensive positioning, Loblaw has a market beta of 0.5, meaning in a drawdown scenario, if the market were to correct 10%, we'd expect Loblaw to go down about half of that. In contrast, it's also provided strong upside participation, good stock momentum. So I think it's a solid defensive holding for equity investors in a current frothy environment.
Your next idea is Power Corporation of Canada, and of course, it's the parent company of the likes of IGM, the mutual fund giant, or Mackenzie, or Great-West Life.
Yes, so it's diversified financial services business, has been around for decades and decades, focused on insurance, wealth management, investment management. This is another steady Eddie stock that provides consistent low-risk growth in most market environments. And they've displayed strong recent business performance, various growth initiatives, intelligent capital allocation, in addition to share repurchases, a good dividend yield, and from a valuation perspective, still trades at a discount to its net asset value, which provides good valuation support for this stock. And lastly, with the beta of 0.6 again, reduced downside participation if we were to hit a market correction or bear market. This is a defensive stock that will really help provide that support in portfolios or reduced downside just versus the market index.
The yield about 3.5%. Of course, the run-up in the shares this year, they're up more than 54%, has tended to bring down that yield. But in a market like this, Julian, should you emphasize stocks that do at least pay some kind of dividend?
Yeah, I think it's important for investors to look at total shareholder yield, which takes into account not just the dividend, but share repurchases as well, because those represent capital returns. So we like share repurchasers. Some corporations that do pay a dividend actually have a much higher yield if you take into account repurchases, which also provide that buying pressure and can support the share price, particularly in a choppy market. So yes, dividend yield is important, but I think share repurchases are even more so.
And then you have a short idea for us, and we had a look at this stock earlier, a strategy, formerly MicroStrategy, and these days all it does is hold a bunch of crypto.
Yes, short idea, or perhaps if you're long MSTR, I'm advocating that investors take some money off the table and exit the stock. So strategy is what's known as a digital asset treasury company. All it does is it holds Bitcoin, and it gets a pretty tremendous valuation for just holding Bitcoin. It currently trades at 1.2 times its net asset value, or the underlying value of its Bitcoin. So either you could buy a Bitcoin ETF, or a Bitcoin's trading around $100,000 currently, or you buy MSTR and pay $120,000 for Bitcoin. So Andrew, it seems like a fairly easy decision to make. That premium has been declining pretty significantly. It's faced a ton of copycats in the market as entrepreneurs and executives have tried to replicate this Bitcoin treasury strategy. In addition, you've seen sort of declining sentiment on that type of business model, such that I expect this stock to trade down to a discount to its net asset value, and the whole machine sort of falls apart. It's heavily reliant on sort of the greater fool theory to convince more and more investors to buy this thing at a premium, that I believe it's only a matter of time before that scheme runs out.
And finally, what about, is there any Canadian tech stocks that you like right now? I mean, Shopify, Celestica, Lightspeed, or any calling to you, Julian?
Yeah, I continue to like Constellation Software. It has been beaten down a little bit, not on fundamental performance, but more of this negative sentiment around AI potentially killing software. We really haven't seen that play out yet, so its valuation has become more attractive. And I previously advocated for Constellation as a longer term hold. And then Celestica, a good sort of shadow AI play that has had exceptional performance and seemingly a beat and raise quarter for the past call it half dozen quarters. So it's performed exceptionally well, but it's really sort of tied into the whole NVIDIA data center growth story, which investors should keep a close eye on. But as long as these hyperscalers are spending hundreds of billions of dollars on AI data centers, then a name like Celestica should continue to benefit.
Julian Klimashko, CEO, Chief Investment Officer at Accelerate Financial Technologies. Yesterday, we learned that Canada's annual inflation rate came in at 2.2% for October, but the core rate was much higher. For a closer look at the costs Canadians face, here's CTV's John Vinavalli-Rao.
While the price of gas is still higher than many drivers would like, StatsCan says the cost for that fill-up has been coming down, with prices falling more than 9% compared to a year ago and 4% in the last month, in part as motorists switch to less expensive winter gas blends, along with another big factor.
This is still being affected by the removal of the carbon tax earlier this year.
And at the grocery store, prices also coming down, falling more than 0.5% from September to October, the biggest monthly drop since 2020. While year over year, prices are still up 3.4%.
Maybe I've seen some small relief in some areas, but still generally higher than they have been.
A lot of things are definitely still pretty expensive. Some things are definitely a thorn in my side, like the price of beef, for example.
The 1 month fall attributed in part to the elimination of many counter tariffs on U.S. products.
The food inflation rate dropped, which is certainly good news, and we were expecting it, to be honest. There's less pressure at the border. Counter tariffs are gone now since September 1st, and it's helping. It's helping.
It's all contributing to overall inflation coming in at 2.2% in October, down from the previous month, though notably some items getting a lot more expensive. Cell phone plan prices rising around 7% year over year, as did home and mortgage insurance and car insurance.
When we talk about stickiness of underlying inflation, insurance is really a big issue, and it's a big issue right across Canada. And I'm sure most homeowners and vehicle owners are really feeling this.
Rent also up 5% year over year. Meanwhile, the numbers released today has economists now betting the Bank of Canada will hold interest rates steady for the rest of the year. John Vinavalli-Rao, CTV News, Toronto.
All right, our last look now at the markets before the end of the trading day. The TSX has been going sort of up and down in the green and the red. It's 20 points down right now, still at 30,055. So down just a little bit on the day. Let's take a look at the movers or the markets, across the border. The S&P is down 46 points. The Dow Jones, a 450-point drop today, almost 1%. And the Nasdaq down 241 points, or over 1%. Up next, the closing bells for Bay Street and Wall Street. Stay tuned. Here are the closing bells for the end of the trading day. At the Nasdaq, Flushing Financial Corporation ringing the bell. In New York, South Bow Corporation ringing the bell. And at the TSX, 121 Mining Investment London Conference closing the market. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX Composite ending the day in the red, 39 points down today. The S&P 500 also down by 55 points, 0.8%. The Nasdaq, a 275-point drop, 1.2% down. Let's get to the movers in Toronto. Peyto Exploration moving up today, gaining over 5% or $1.12 to end the day at $22.40. It's up 43% over the year. Birchcliff Energy also moving up today, ending the day just over 6% up or 40 cents, ending the day at $7.05. Superior Plus gaining today as well. Superior Plus end of the day 6% up. And then let's get to Capstone Copper. It lost over 6%, closer to 7, 81 cent drop to 11.23. TELUS today also moving down. TELUS dropping over 5%, losing $1.06. It's down 11% on the year, ending the day at a flat $19. Let's go check out the mover south of the border. We have equities reporter Matthew Griffin joining us now from Bloomberg. Matthew, there was a downgrade for Microsoft and Amazon today. What led to that?
Yes, so Rothschild & Co. Redburn cut the recommendation on both stocks. They now sit at neutral versus buy before. And the reason's pretty simple, but it's also pretty dramatic to hear in today's market. They say that the economics underpinning AI are far weaker than previously assumed. This is just the latest voice to join kind of a chorus questioning what the return's going to be on the tens, hundreds of billions of dollars that American companies are investing in AI. And investors did take note. Microsoft fell 2.7% today. Amazon actually down even more. And continuing slides that have come as Wall Street has questioned the high valuations that some of these AI-related names have gotten. Microsoft now down about 9% from a high last month. One other thing I'd point out is you actually have news of a deal today. Microsoft is going to invest up to $5 billion in AI lab Anthropic. It's a deal that NVIDIA is also involved in. And in the past, you might have gotten a positive share reaction to something like that, but it didn't really move the needle today. And I think that's just another sign of the kind of skepticism that Rothschild & Co. Redburn is talking about here.
Yeah, definitely deepening for the tech stocks. All right, Warner Brothers also on the move today. It spiked. What triggered that?
Yes, so Warner Brothers Discovery up today on a report from Variety that Paramount is considering a deal to buy the company that would be about $71 billion US. The sovereign wealth funds of Abu Dhabi, Qatar, and Saudi Arabia would also all be involved in this deal, with Paramount putting in $50 billion of that total. It's really just the latest bit of drama in the entertainment business. I mean, Paramount Skydance itself, the result of a long, winding road to a merger. And then when you look at Warner Bros., you've got news earlier this year that they wanted to split their company into two businesses, then reports that first Paramount, then Comcast and Netflix looking to throw their hats in the ring to buy them instead, potentially submit bids. And it's all driven Warner Bros. Stock up about 90% from those first reports that Paramount Skydance was interested. We will see what emerges from kind of this long list of names that are involved, which plan Warner Bros. Goes with, maybe which company, which buyer they go with, and what that means for the shares and investors from here.
All right, let's also get to Merck gaining today. On what news there?
Merck, the drug maker, they had positive results from a trial of a drug for rare forms of high blood pressure. The drug's called Winrevair, and it's actually already on the market for one rare version of high blood pressure. But they got positive results for a study they're doing for another one. It's called combined pre- and post-capillary pulmonary hypertension. I think I've said that right for the second time today. And this is an indication we've still got a little ways to go, but if it does get approved and does well in a late-stage trial, Scotiabank says that could double the market size for this drug. So Merck, the stock's been beaten up this year, but it did rise today to close at the highest level since February. So a little bit of a glimmer of optimism for investors there.
Okay, appreciate the update. Thanks very much. Let's have a look
Thanks for having me.
Let's have a look at what moved today in Canada. Bloomberg's equities reporter Jeff Morgan joins us now. Jeff, JP Morgan downgraded TELUS. So is this because of the dividend?
JP Morgan downgraded TELUS largely because of a view on competition. A bit of a rough one for TELUS. They were the second worst performing stock in the TSX Composite Index today. Not performing very well. Not only did they downgrade the stock to sell, now the stock has 2 sell ratings, but it also cut the price target to match a street low. So $19 a share is where JP Morgan thinks that TELUS Corp shares should trade down to. And as I said, that is matching the lowest estimate on Bay Street. As I said, it's the view on competition. JP Morgan is seeing potentially some erosion of their market share base in Western Canada, and that's largely driving the downgrade this afternoon. And the stock performance today, really rough one for them, as I said, second worst performing stock on the TSX Composite.
All right, let's talk about some news on the Tech Resources deal, because there was a comment by one of the ministers today. What did Melanie Joly have to say?
Yeah, Melanie Joly had a few comments that were reported in the Wall Street Journal today about the Tech Anglo-American deal. The stock is the stock is performing poorly. It was among the worst performing stocks in the TSX Composite today. And the commentary was really that so far, at least, the offerings from Anglo-American to try to close this deal to acquire Tech Resources may not be enough to win the backing of the Canadian federal government. And so the stock is trading off as a result of that. It should be noted, however, that there were a handful of other copper mining companies that were trading lower as well on Tuesday afternoon. So perhaps a bit of a combination there. Certainly the comments from the minister didn't help. This was one of the worst performing stocks in the TSX Composite today.
All right, we will leave it there. Jeff, thanks for the update. Appreciate that. Coming up next, we'll have a look at the markets as the major indexes in the U.S. ended the day in the red. So did the TSX. We're back in a moment. Another down day for North American markets, with broad concern about tech stocks and what some see as a warning coming from a key retailer. Let's go to Warren Hastings, Managing Director at Scotia Wealth Management. Warren, thanks for joining us today.
Thank you very much for the invite to the show, Morella.
So what's your take on what's feeding this downturn?
The downturn that we've seen today has, in many respects, been due to stocks in or associated with the AI theme. The high valuations, a lot of the capital, the amount of capital that's being deployed toward that technology has resulted in some concerns about the returns that investors are likely to see with respect to those sort of stocks. And while we believe that AI will be a profound technology, our bank wrote a report on it earlier this month. It doesn't mean that there aren't some stocks that are susceptible to a pullback. And I think that's what we've seen in markets, in particular the U.S. Equity markets today.
Okay, would you call this a healthy pullback then?
I think a correction it was due at some point, and I think markets operating efficiently would suggest that some profit taking was bound to occur, particularly with some of these high-flying stocks that have done very well on a year-to-date basis.
Do you expect it to continue this way? I know it's hard to sort of predict what's going to happen from what you've seen in the past sort of week. Do you expect the downturn to continue?
Hard to say what goes on from day to day. The fundamentals of the sector are still very strong. Profit growth and revenue growth, even for those stocks that are at the epicenter of the AI theme, are still quite robust. And so while we might get some short-term volatility, it's not our anticipation that there is a major correction on the horizon.
Okay, let's talk about Home Depot earnings for a moment, just in the sense that it was a miss on a lot of the metrics. And some are taking it as a warning about the retail sector or consumer weakness generally. Do you take it the same way?
So I'm going to sidestep any comments on Home Depot in particular, but with respect to the economic outlook, we still anticipate economic growth, not robust, but sluggish economic growth in the North American economies, in particular in the U.S. and Canada. In both countries, driven by fiscal stimulus, and lower interest rates should help as well, particularly stateside.
Okay, I'm going to take the stimulus comment in a moment, or take that up in a moment. Should we take what we see with something like a Home Depot as a forecast for the retail sector at all in the holiday season, when we already know from early surveys that consumers say they're going to pull back a bit?
There could be some takeaways with respect to the consumer, but at the same time, it's important to remember, particularly in the U.S., that recently passed tax legislation should help consumers at all ends of the income spectrum with lower tax rates.
So we also know the budget has passed here in Canada. How soon do you expect to see impacts of the money flow into the market?
Well, as soon as the legislation becomes law, I think we could expect to see some of those benefits flow. In particular, this budget was focused on, or premised on, a $280 billion investment package directed at infrastructure, at productivity improvement, defense, and housing. And like I say, as soon as that becomes law, we could expect to see some of those funds and the projects associated with them begin to flow.
Yeah, if you could expand on that, tell me what kind of sectors you think are going to really materially benefit from that budget.
Well, in particular, the industrial sector here in Canada, because of its association and good representation, companies in the construction, in the engineering, aerospace, and defense subsectors should stand to benefit from the budget once it becomes law.
And do you think that money could start flowing as soon as next year, or is that too early, because we know a lot of this will just start out in a basic planning phase?
I think those funds could begin to flow as soon as the projects associated with them are approved by regulators and by federal government authorities.
Yeah, so we'll see what the Major Projects Office has to say. Warren Hastings is the Managing Director of Scotia Wealth Management. Thanks for your time. Appreciate it.
Thank you very much, Marilla. Appreciate being on the show.
With holiday spending increasing, retail scams are also on the rise. We'll talk about the new ways the fraudsters are getting to you. Back in a moment. AI is not only making our lives easier, it is making thieves richer. As we head into a peak shopping season, you should be aware of the latest threats. Larry Zelvin is head of the Financial Crimes Unit at BMO Financial Group, and he joins us now to talk some more about this. Thanks for your time today.
Thanks, Marla. Great to be here with you.
How easy is it to become a victim of fraud these days?
Well, you don't even have to try. They'll come and find you. Unfortunately, I think folks, they're getting you on your telephone, they're getting you on text, they're getting you on email, they're even mailing you things. No matter how you live your life, they're finding you.
Okay. How has AI in particular made life easier for fraudsters?
Well, it's lowered the bar to entry. It's so much easier for them to actually create a very convincing phishing or email or text. They're using deep fake to create video and voiceovers, so it can sound like somebody that is perhaps living in your neighborhood or somebody you grew up with. Meanwhile, they're actually living on another continent, and they've really crafted the art of how to lure people in and take their emotions to the places where they'll do things that they might not normally do. So it's really becoming a lot harder. If we would have asked me 2 years ago, I would have told you watch out for misspellings, watch out for little things, but they've gotten all that down, so it's almost impossible to tell the good from the bad, but there are some telltale signs.
Okay, so if we are, for example, shopping online, you don't want to go to the malls, it's really busy, you want to do it online, what are some of the things we need to watch out for these days?
Yeah, look, if it seems to be too good to be true, it probably is. Watch those deep discounted bargains, because in many cases, they're not real, they're fraud. Be careful of sites that are not reputable or that are rather new. I'm not putting down TikTok, but if you're going to buy something on some social media sites that's not part of an application or a website that's trusted, just make sure you're being very careful before you pass any of your credit card information or any of your payment information. The last thing I would say is if you're really not sure, you maybe want to do some research, but the biggest advice I can give people is just slow down. Think about what you're doing, and before you give out your personal identifiable information, before you give out your payment information, before you give out any two-factor authentication, make sure that you're doing it to somebody who's not about to take advantage of you.
So, Larry, that's part of the problem, right? Is that there are so many retail sites now that we might have known the big players back in the day, but these days you can go anywhere in the world and shop for almost anything. So if you're on a site, is there an indication that it's not real? What else could you watch out for?
Yeah, as I said, you've just got to be very careful in watching. And again, you should shop online. I'm not saying that you shouldn't do that. You absolutely should. But what you've got to be really careful about is if all of a sudden you're on a new site, or if it looks a little bit different, if you had to click on a different link or an attachment to get there, or you had to install some new application, those are telltale signs. If you are using applications that you've always used, hey, the website is about right, those are all good things. But if you're going to anything new, you want to have a higher level of vigilance. You may want to do some research, Google, Better Business Bureau. But again, you just need to be careful out there because there's so many bad actors that are trying to steal your money. Unfortunately, we can't defend against everything. You're going to have to do some of it yourself. And I know that's a bad answer, but it's just the way it is.
All right. So that was online. What about if you're shopping in person at stores or at the mall? Do we need to worry about anything on that front?
You do. I would recommend not using public Wi-Fi unless you want to check sports or like news. But if you're going to do anything around payment information, anything that it gives your username, password, anything that's personal, don't use public Wi-Fi. Be careful of the QR codes. They're very convenient. It's a great way to kind of get to something quickly, but unfortunately, very few of us are actually looking at the link, and it could be taking you to a malicious site. The last thing is, and folks, this is the most scary part, there is some technologies now that if you're in a tight space, albeit a train station, a bus station, or even out shopping, somebody bumps into you. Unfortunately, there are these electronic devices that can break into your phone and steal your payment information. So you may need to take a closer look at your bank accounts and your credit card information if that happens, because you may need to turn off your credit card system or notify your financial institution sooner if you're seeing frauds.
Okay, is there any way to stop that from happening? I mean, are we at a point where we shouldn't have our payment information on our phones?
No, I don't think we're at that level yet. And again, it's one of those things that's happening, but not widespread. But there are some capabilities you can buy. I won't name them, but if you look and say, how do I protect my phone against these frauds that use the ability to steal that information? There are some blocking devices you can do. But folks, I will tell you, that's the exception, not the norm. So please don't overreact to it, but it is something that you're going to need to be aware of. And again, if you get bumped, you may want to just take a closer look at your credit card information and your banking information to make sure that nothing is wrong over the next 48 hours.
All right, Larry. So last piece of advice, part of it was you said slow down, but just give us the last piece of advice for people who are going to start their shopping.
Yeah, look, just continue to watch your accounts. I have alerts whenever I spend over certain limits. Same thing with my family. If you detect that there's any anomalies, anything that's wrong, reach out to your financial institution, your credit card holder, whoever that may be. The sooner you can get with those folks, the sooner you can get with us, the better you will be. We'll notify law enforcement. Canadian Anti-Fraud Center is a great site to go to. The other thing is look, don't be ashamed. You're a victim. Too often people don't report because they feel like they've done something wrong. Somebody will yell at them. That people will criticize them. Folks, you're a victim. Please report. Please tell the appropriate folks that can help you. And folks, be careful out there, but enjoy the holidays.
Larry Zelvin, thanks for joining us. Larry's head of the Financial Crimes Unit at BMO Financial Group. The Canadian Real Estate Association says the number of homes that changed hands in October was lower compared to a year ago. Prices are also down. CTV's Adrian Gobriel has more on that.
I've been struggling, basically making income.
Miriam Mousavi admits she's been struggling financially as a full-time real estate agent in the Greater Toronto area. Her net income has dropped significantly since home sales in her region began to plummet.
200 to 300K versus for past year, I think I didn't make more than 50K.
A single mother, she was forced to list her own home in April. 7 months later, it hasn't sold.
I have to basically beg people to come and just even look at the house.
The national average sale price of a home sold in October was just over $690,000, down 1.1% from a year ago, according to the Canadian Real Estate Association.
If you're in Quebec or you're in Saskatchewan or you're in Atlantic, you're in good shape. If you're in Ontario or British Columbia or maybe even Calgary, you got some issues.
This home east of Toronto was purchased in September 2024 for $2.3 million. Last month, it sold for $1.2 million. The seven-figure loss is the result of a power of sale.
Power of sales are way up in the GTA. They're up 90% compared with what they were just a few months ago.
Losing the homes to the banks is a real possibility that has led to sleepless nights for Musavi.
I've never seen anything like this before. With no income, I couldn't even pay my mortgage, and I have to sell the house.
The Canadian Real Estate Association expects the housing market to become more active in 2026, though some experts we spoke with say the economic uncertainty could prolong the pain for many. Adrian Gobro, CTV News, Newmarket, Ontario.
Let's have a quick look at the markets and how we ended the day, which was in the red again. The TSX Composite down 39 points. It had been up a little bit, down a little bit today, but ended the day still above 30,000 at 30,036. The S&P 500, a 55-point drop here, 0.8% down today. And then the Nasdaq with a 275-point drop, or 1.2% down. So that streak of red continues here for the North American markets today. Can we have a look at a couple of different movers for the TSX to see how we ended the day there? We will start here with Peyto Exploration. It ended the day 5.26 up, a gain of $1.12 to $22.40, and up 43% over the last year. Let's get to the next mover for Toronto. That's Birchcliff Energy. It gained 5.4% today. That's a gain of 37 cents for this company, and it ended the day at $7.26, up 46%, almost 47 over the last year. That does it for us today on The Close. Thanks for joining us. We'll see you back here tomorrow.